Welcome to the February 26, 2021 video version of the Wagner Daily. My name is Rick Petticelli, and as usual, once a week, this video replaces the written commentary portion of our report. Hopefully it serves as a nice change of pace, as well as offers some insight as to how we set up our charts, what timeframes and indicators we use. On the left here is the daily chart with the 5, 10, and 20-day EMAs and a 50 and 200 SMA. This is the RS line versus the S&P 500. And this is volume with the 50-day moving average. On the right-hand side, we have the weekly chart with the 10 and 40-week MAs and a 200-week MA. And we have volume with a 10-week moving average. So first up is the NASDAQ composite, which closed below the 50-day MA for the first time since the last rally began on 11/4. So earlier this week, the NASDAQ lost the 20-day EMA, which had contained the rally for the most part over the past few months. And then there was confirmation with the break of the low of the day that broke the 20-day EMA. Then there was a 2-day bounce, and now there's further weakness with a break of the 50 MA. So conditions have deteriorated quickly this week, and even more so on the NASDAQ 100, where the price took out the bullish reversal candle on 223, which is not a good sign when this type of reversal candle is taken out. And the price is already well below the last swing low from 129, which the NASDAQ composite is still above. So that's clearly some ugly action. And the longer the NASDAQ composite and the NASDAQ stay below the 50 MA, that will increase the odds for further selling. So let's see over the next few days how the NASDAQ reacts to Thursday's sell-off and this clear level of support around 13,000. It's such an obvious support level that, there's always the possibility for the price action to break below the level and then return back above. So that's what we'll be monitoring over the next few days. The S&P 500 recovered from a confirmed break of the 20-day EMA a few weeks ago, quickly recaptured the 10 and 20-day moving averages and went back into trend mode. And then on Thursday, closed back below the 20-day EMA and is just above the 50-day MA. So it's showing some relative strength versus the NASDAQ. But there is some concern here, as one of the better performing areas in the S&P as of late is the financials. And the financial ETF XLF closed with an ugly bearish engulfing candle at the highs after a pretty strong rally. Energy also led the rally, and it also closed with a bearish engulfing candle. So if these sectors begin to reverse, it's going to be tough for the S&P 500 to reclaim the 20, and it might even be difficult for it to hold on to the 50. IWP, which is a mid-cap growth ETF that we monitor, as many of the stocks we like to trade are in this ETF. And there was a nasty slice through the 50 MA on Thursday. There's quite a bit of support in this 101 to 102 area. And we'll just have to see how the price reacts to this support level next week. Next up is ARCK, the ARCK Innovation ETF, which is a popular ETF focused on innovative technology. And as you can see, just a nasty day on Thursday. The price action sliced through the 20 and then really through the 50 MA and couldn't recover back above the 50 and was down 9% today. And in the weekly chart here on the right, you see this big volume breakdown below the 10-week MA on just the biggest volume it's seen. So IWM, which is the strongest index this year and over the past several months, also closed below the 20-day EMA, which it did in January and recovered back above. But a move below Wednesday's low would confirm the break of the 20-day EMA, which is our line in the sand for strong price action. We always want to assume that stocks that are trading above a rising 20-day EMA are going to continue to go higher until the 20 EMA is broken. And when it does break, we generally look for price action to head lower, or at the very least go sideways for a few weeks to digest the recent advance. So just a quick review, the NASDAQ's below the 50 MA, the S&P is below the 20 at the 50, IWP is sliced through the 50, ARCK sliced through the 50, not recovering, QQQ sliced through the 50 and making lower lows, and IWM is below the 20 and may confirm a break of the 20. Let's take a look at some the 11 sectors that I have in TC2000. First up is technology, which is at the 50 MA, and this is the first pullback to the 50 in several months. So we'll see if the price action can hold up in this area, very much like the NASDAQ composite. There's some support around this 9,400 to 9,500 area. We'll see if that holds up. Healthcare, testing support here. We'll see if there's a dip below and a recovery back above. Consumer cyclical near the 50 MA. Industrials with an ugly reversal here. We could see a pullback to the 20. Basic materials, an ugly reversal day two after moving higher the prior session. Could see a pullback to the 20 or lower. Consumer defensive below the 50 MA and pulling back into support. Financials, ugly reversal. Energy sold off and gave back more than half of the prior day's strong advance. So that could be a weakening over the next few days. Nasty sell-off in REITs. Communication down to support. Well, not really a trending sector anyways. And utilities, again, not really a trending sector and selling off. Looking at these sectors, there's really no promising price action. We just have a few leading sectors that are likely going to pull back now after a strong move up. And then we have several that are at critical support levels. Next up, we're going to run through a few stocks that are, I would classify as the leading stocks coming into this week of trading. First up is Tesla, and I don't know what happened to this daily chart, but let's just say it closed at 667, around there. So it snapped through the 50 and tried to bounce back above and was smacked back down again. PLTR lost the 50. PayPal is at the 50. SQ lost the 50 on big volume. Shop is at the 50. Roku broke down below the 50 MA on volume. Twitter is one of the strongest stocks in the market, but this is a false breakout here at the highs. Snap tried to break out. Wrong time to do so. It was smacked down to the 20-day MA. And I'm just running through these charts pretty quickly to give you guys an idea of what's going on this week. A strong reversal in pins on 223. Looks like it's given back the majority of that reversal. PDD broke the 50 MA on a pickup in volume. SC is going down to the 50. Crowd reversed back above the 50 MA on 223. Closed back below on 225. TTD tried to reclaim the 50 MA, gap below the 50 MA, and now it's heading lower. U was blown up, still on this list. I don't know why, but it was something we were looking at a few weeks ago, and it was hit pretty hard. Docu with an ugly break of the 50 again, but pretty much still in just a big range here. T-Doc with a nasty break off the highs, just really ugly breakdown. It sliced through the 20, then bounced for a day off the 50, and then a nasty big volume break of the 50 and closed just above the 200. Let's see here. Net also below the 50 MA. So you get the picture. Our bread and butter is buying growth stocks that are ready to break out and move 20 to 40% higher over 2 to 8 weeks. And right now, these stocks are not ready to move higher for more than, 1 day, a day and a half before selling off again. So there's really nothing to do from a long perspective in terms of trading growth stocks. And I would think if anything is in play, it would be more for the very aggressive trader who's more focused on hourly charts using 5 or 15 minute charts to establish entry points. But if you're doing any work off the daily or weekly chart, this is just not going to be your type of market. Now for the good news, market corrections are a good thing because they produce new setups eventually. New basing patterns, and possibly ones that are longer than the 3 to 4 week patterns that we've seen over the past few months, because the market's been in a steady uptrend. So we finally might get a shot of seeing some cup with handle patterns or some legit 5-week flat basing patterns. So that is something to look forward to down the road. But for now, we're content to sit in cash and see how the market reacts to Thursday's selling. Thank you for joining us, and we'll see you again next week. Have a great weekend.